Let me introduce our speaker for today. His name is Alex Siu. He has extensive experience in fund management industry. Currently, Alex is the fund director of SC licensed robo advisory firm, which is called the BH Global Fintech Solutions Sdn Bhd. Formerly, he served as a fund manager in VCB Capital, a boutique asset management company, for more than 5 years. Alex is also a CPE speaker for the SIDC for more than 8 years. He was the first chairman of Malaysia chapter of CMT Association. So without further ado, let me pass the presentation to Alex.
Okay, so I am always researching new indicators, new systems. I'm more of a research scientist person rather than a manual trader. So it is always very exciting when we have new technology that can enable us. It's meant to enhance our trading, give us greater clarity, to see the trend clearly, to be able to see an entry point clearly, exit point clearly, and to be able to see our risk management clearly. That is the purpose of new indicators, new systems, new technology. Of course, if I speak things which are too advanced and too new, probably you might not get it. So that's why Excel suggested to me, oh, why not you do something that everybody has, like all the Malaysian brokers have this indicator, not just this one ATR, but any other indicators that is popular and people, everyone has it, and just maybe teach more in depth how you can utilize best this existing indicator rather than speaking of something that most people do not have, right? So currently, I'm in the research of next generation quantum computing, HFT new strategy. So that was pretty exciting with AlphaGo unsupervised learning technology, as well as different types of nanosecond speed technology in news absorption and all this. I will have to go back to the basic, like how ATR has been enable fund managers to be able to manage their risk since 1980 something until today. There are still many fund managers and traders who uses ATR as a way of managing risk and doing position sizing. Okay, so I will go back to basic and bring you through again this old story of how ATR came about, the turtle story, so that you might appreciate this indicator that is already in your broker's platform, being any broker that you're using, Maybank or RHB or CMB, any broker, all of them, or even foreign brokers like Interactive Brokers, TradeStation, I'm not promoting any broker. All of them have ATR, even MT4. So that's the purpose, is to share something that everybody has, and maybe you are able to understand more in depth. Okay, right, a bit of disclaimer. I am not going to sell you anything. I'm not going to give you any investment advice. It's all basically for education purpose. Okay, right. So first part is where does this ATR come from? When did it started? People started to use it, and who invented it? That is really important. Like for example, if you use Bollinger Band, you should know that it came from John Bollinger. He wrote a book on Bollinger Band, okay, and he teach people very detailed how Bollinger Band should be used together with Bollinger Bandwidth, in his book, John Bollinger on Bollinger Band. So it's very important you know exactly where does this indicator come from, so that you'll be able to use it correctly. So back to ATR, which is the only two, I think, volatility-based indicator that are available in everyone's platform is ATR and Bollinger Band. So today I'm going to talk about ATR, not Bollinger Band. Okay, so it is a volatility-based, okay, technical analysis. Technical analysis, there are many aspects of it. Okay, there's this quantitative aspect where you quantify all sorts of formula, like you look into the formula of Bollinger Band, the formula of MACD, the formula of stochastics, and then you change and modify the formula to make it something else. That's the quantitative way of doing technical analysis. And then you also have the chart patterns, like Thomas Bugowski's Encyclopedia of Chart Patterns, where you memorize a lot of chart patterns, like double bottom, double top, triple bottom, head and shoulder. That is another form of technical analysis. And then you also have pure candlesticks, yeah, by Steve Nissen, and beyond candlesticks. So analysis of candlesticks, so-called price action, is a form of technical analysis as well. Yeah. Then another form is basically you have the news, right? Studies of news and how news impact and the technology on news. That's another aspect. So there are many aspects. So one aspect of technical analysis is called volatility-based technical analysis, and there are not many indicators in the market that people know of that is based on volatility. But we know that volatility is the most important now because the market is so volatile, especially recently FCPO, right? FCPO, the volatility increased by a lot more opportunity, a lot more risky to trade FCPO. So let's talk about volatility and how we can actually try to trade FCPO and manage its risk. Because if you don't manage the risk of FCPO, wow, you can actually, I look at the volatility, one day, one contract, you can lose even up to 10,000 ringgit. That is crazy, right? Now it's having crazy volatility. So volatility become very, very important. And the people who first thought of volatility in Wall Street is none other than Richard Dennis and his friend. You know, Richard Dennis, he first brought this term of volatility and utilizing it in trading, where people of his time do not really commonly use volatility. So what can we learn from the early days traders in terms of a volatility model? You have to go back to the turtle experiment. Yeah, I'm not sure whether you heard of turtle experiment, but I'll just tell you the story of turtle experiment. Okay, so let's talk about the story. Yeah, Richard Dennis, Prince of the Pits, and his good friend William Eckert, the mathematicians. So Richard Dennis, at 1982, he was rather rich already. He was very successful in the stock market, in Wall Street, yeah, in the financial market. He mainly trade futures, not really stocks. So he was called the Prince of the Pits, and he kind of like semi-retired. He went to Singapore with Bill Eckert together, have a holiday, 1982, right? And then they were looking at the turtle farm in Singapore. I didn't know that Singapore has turtle farm until I wrote this. I read this book. And they were debating over a very important question, which until today, that question is very important, because when banks recruit traders, should they recruit traders from Ivy League only? Okay, that means that traders who are like from really the elite group, who are always super smart, all top A's from Harvard or whatever, should they only recruit traders like that? Or can anyone be trained to become a good trader as long as the bank themselves have good training program? You know? So that was nature versus nurture kind of argument. So Richard Dennis was in favor of nurture, and Bill Eckert was in favor of nature. So William Eckert felt that anyone who is smart and is genetically suitable to be trader only can be trader. Whereas Richard Dennis felt that anyone can be trader. I can train anyone to be trader. You can just give anyone to me. Yeah, from the street, I'll train them to be trader. So they make a bet during when they were looking at the Singapore turtle farm. So what resulted from that is that after they went back to US, they started an advertisement in Wall Street Journal. You know, like, okay, let's conduct an experiment. Let's recruit like 16 people from the street. The most important is none of them has any financial background. They have never traded before. They are total newbie. So just to be fair, yeah. But it's of course up to Richard Dennis and Bill Eckert to decide who they want to select. Yeah, it's a fair game, so they have this advertisement that appeal to everyone. So there are many people apply, thousands of people apply, but only 16 candidates were selected to be in the program. So of course, among the 16 selected, none of them have financial background. They are some of them are maybe housewife, student, Curtis Face was a student when he was recruited. Maybe retired soldier, chess player, yeah. But none of them from the financial world. So it's quite fair in that sense. Okay. So these people were trained for about a month. Okay. Second batch was recruited 1 year later. They were only trained for 2 weeks for the same methodology. And they were given $250,000 to trade right away after training for 2 weeks. So that's pretty crazy. That's pretty crazy. And of course, I myself, I have repeated this turtle program as an internship program on our company 9 times. I've done it 9 rounds. And there were many hedge funds that actually do turtle program, imitating the success of the Richard Dennis turtle program. And the one that is most popular is the BBC $1 Million Trader, by this Anton Kriel and Lex Van Dam, the 2 Goldman Sachs trader. They repeated a process and then they make it into a reality show, and you can watch the whole movie in YouTube. Just $1 Million Trader, you'll be able to watch it. So that was pretty interesting. Everybody want to imitate the turtles. Why do I want to repeat this turtle experiment 9 times? It's because of the result. It's because of the result. If the result fail, nobody will be interested to imitate them. But the problem is, the thing is, the result were phenomenal. It was so unexpected that someone who is only trained for 2 weeks can perform that well. The first batch, the Liz Chevelle and Jeff Gordon batch, they started 1984. The second batch started 1 year later. Is the Tom Shanks and the Jim DeMaria batch, okay, Paul Rabar batch. So they started 1 year later, and the experiment ended the end of 1987. Okay, so that's why from here we can guess who is the winner, right? So Richard Dennis was the winner. He proved to his good friend William Eckert that all traders can be trained, nurtured in a very short time. And this forms the foundation of all the market guru out there. 3 days and you can become a good trader. 1 week and you can be a good. That is where the quotation comes from. Oh, because the turtle program is successful, anyone can become a trader in a few days. Well, of course, most of the seminar guru out there fail to convert any strict people to become trader overnight, right? All of us know that it's not that easy. So there must be some secrets and success that this Richard Dennis brought to the table so that after 2 weeks of training, the turtles are able to perform right away. There must be some secret to it, correct? So that's why we are here to explore the secret, right? We are here to explore the secret. So they were actually very, very sought after, After the 1987, they become world famous. Wall Street reporters all try to interview them, but they have signed an NDA of 20 years. They cannot disclose what Richard Dennis has taught them over the 2 weeks or over the 1 month. So 1987 to 2007, they were not allowed to disclose. So 2008, finally, the NDA already expired, so they are allowed to disclose, but most people will not disclose except Curtis Faith. Curtis Faith, actually, this guy is the one who disclosed in his book, The Way of the Turtle. So of course, it became an instant bestseller because everybody were already curious for 20 years. Like, what did they learn in that 2 weeks, right? So just to prove that it is not luck, okay, but it is skill. You can see that the expectations, the age expectation of Dow Jones, NASDAQ, and S&P, if it's just by pure luck, it should be less than the age expectation of all the 3, right? It should be less than 0.6, the age expectations. And the winning months is about 58, 57, okay? But the age expectation of Liz Chevelle, Jerry Parker, and Paul Rabar, they are way, way higher. 2.5 for Paul Rabar, 1.38 for Jerry Parker, and 2.83 for Liz Chevelle. The age expectation, that proves that that is not by chance, right? That's not by chance. That is skill. That's not by chance. So if you see further that the inceptions until 2006, right? Yeah, the age expectation is around roughly less than 1. It's basically less than 1. Whereas consistently, not just over stock index or US stock markets, but also over futures, over commodities, over currencies, the age expectation of the turtles way surpass any asset class. That's just to prove that it's not pure luck. It's not because the asset class just performed really well. Therefore, everyone makes money. No, it's because they really have a certain expectation way above the asset class performance itself. So they also trade currencies. They also trade commodity futures, including crude oil, gold, and silver. And that period, these commodities and these currencies, they have negative age expectation. But not to be deterred, these turtles still make money. So it has to be skill and not just luck. That's why this slides is to prove to you that it's not luck, okay, but it is real skills. So the famous experiment of 1984, and all of them become millionaires. Some of them become fund managers. Some of them just trade their own money. Okay, so after 24 years, Curtis Fish shared the secret methods in the way of the turtle. So everybody were curious, what is the secret, right? So let's have a look at the secret. First part is the entry method. It's very, very simple. At the same time, it's very, very counterintuitive. Trust me, it is very counterintuitive, right? If you look at how Malaysians used to think, right? How Malaysians used to think, buy low, sell high. That's exactly the opposite for the turtles, right? They will only buy when it breaks the high. It breaks above 20 days high, they will buy. If it does not break the high, they will not buy, right? And then the second system is if it breaks above 55 days high, then they will buy. Okay, so one is a 3-month system, one is a monthly system where it breaks the monthly high, they buy. The other is a longer term system where it breaks around 3 months high, then they buy. Or it breaks the low of 20 days, then they short. They can buy, they can short, they can long, they can short. Yeah? Or it breaks below the 55 days low, they short. That's the S1 and S2 system. So it's very simple breakout trend following system. But even until today, it's very difficult for Malaysians to follow because Malaysians just love buy low, sell high. We can't do buy high, sell higher. It is so difficult to do buy high, sell higher, right? But that is one part of the strategy is trade something that can long and short. So what does that mean? Bursa stock is out. The turtles will not trade Bursa stocks. They can't short. Bursa in futures is okay. You can short. You can short the KLCI. You can short the FCPO. Can long, can short. So probably if it's available to them that time, they probably can trade FCPO and FKR. But of course, it was not available to them that time. Okay, so futures and buy high, sell higher, short low, buy back lower. Okay, so that is one part of the strategy is the entry. Okay, now let's look at the second part of the strategy. Okay, the second part of the strategy is actually what is the key, and it was revolutionary during that time, which is a trade management or risk management using a key component called N, right? So risk management was unheard of that time. Like, who manages risk? What risk? What is risk? People don't even have idea what risk is in 1984, let alone a way to manage risk and a way to measure risk. So volatility is a way to measure risk and is expressed in the term average true range as a way to measure the market's volatility in 1984, and that is called N. Okay, so it has a formula. It has a formula. This is the formula. It's a very simple formula. You don't need to know the formula in order to use ATR in your platform, but it is good to know the formula. So let's go through one example how ATR are calculated. Okay, so true range is the maximum of the tree. All right, true range of the day is the maximum of the tree. One is high minus low. One is high minus yesterday's close, and another one is yesterday's close minus today's low. So example, okay, high minus low is 524 minus 513. So the difference is 11, right? So high minus low, the first number, TR1, true range 1 is 11. TR2 is today's high minus yesterday's close. Today's high is 524. Yesterday's close is 516.5. So 524 minus 516.5 is 7.5. Right, that's TR2. TR3 is yesterday's close minus today's low. Yesterday's close is 516.5. Today's low is 513. The difference is 3.5. So TR3 is 3.5. So that's true range 1, true range 2, and true range 3, right? True range 1, true range 2, true range 3. And the biggest number of the 3 is the true range of the day. So 11, 7.5, 3.5. So what is the biggest number? The biggest number is 11, right? So 11 is the true range of the day. And the same calculation for the next day, okay, and the next day, and the next day. I hope you all get what I'm trying to say. Yeah. So it's basically calculation of true range. Okay. So 8 to 6, the biggest of the 3 is 8. So the true range of the day is 8. So they repeated this process for 20 days, yeah. And then they take an average of the 20 days, which is 11.94. 11.4 is the average of the 20 days true range, and therefore is called the average true range. It's pretty generic name, isn't it? Pretty generic. So it's quite easy to understand. Where does ATR come from? Average true range. So that is 11.94. Okay. Let's see if you can, like, guess what does 11.94 represent, right? Maybe you can just type at the chat box. Okay, what do you think is 11.94? What is 11.94? What does that represent? Can anyone type in the chat box, give it a go? What does that mean? Right? I give you 10 seconds to do it. What is 11.94? Okay. Average value, 20 days, trend change. Okay. Some of the answer, volatility. Okay. True range, average for 20 days. Okay. Just in a very layman term, nothing specific. Price fluctuation of the day, average change performance. Okay. Very, very creative answers. Very good. Some of the answers I never heard before, never seen before, but they're very creative. Volatility value, range of the day. Okay. Fantastic. Fantastic, right? You have a general understanding that is related to volatility. That's good. Okay, but let me give you the answer, right? The answer is that is how Richard Dennis measured the volatility of this product that he's trading of the past 1 month. Means if he's trading gold, he's measuring gold's past 1 month volatility, last 20 days volatility, so that he knows how he can plan in the upcoming trade his stop loss and how many contracts of gold he should enter based on the last 1 month's volatility. That is what ATR is about. Okay, so I hope you guys understand, right? Appreciate what ATR is about. Okay, so that's ATR. So let me give you an example here, right? So this is another thing. This is a S&P in the 2014 S&P. That's the value. So you just have to, you can use it for anything. You can definitely get this platform, this template from me for free, right? You just have to plug 20 days figure. The ATR will automatically come out on its own in the highlighted yellow cell. Okay, so this is S&P, and the ATR happens to be 43, right? 43.46. After you plug in the 20 days value, open, high, low, close, right? And for S&P E-mini, 1 point equal to $50, very much like, FKLI, 1 point is 50 ringgit, right? So 43 points times $50 is about 12173. So you need to risk about $2,173 if you want to trade 1 contract of S&P, right? 1 contract of S&P. And if you, let's say you have 100,000 and you are not willing to risk more than 2% in 1 trade. So that means that 1 trade you can risk up to 2,000 only. So what does that mean? That means that are you allowed to trade this S&P? It means that you are only allowed to trade maximum unit up to 0.92 unit of S&P E-mini. Okay, so of course you say, oh, there's no 0.92 unit. Minimum is 1 unit, right? True. That will means you are not allowed to trade S&P if you don't have enough money. Because you don't have enough money, then you will say, oh, who says I don't have enough money? I have 100,000, right? Exactly. That is called risk management. If you are only willing to risk 2% of your total capital in one trade, which is exactly what Richard Dennis they all do, then you are not allowed to trade S&P because minimum one unit you're allowed to risk up to 2,173. That's beyond what you are allowed to risk, correct? That is what ATR is about. It's about risk control. So are you able to trade S&P? The answer, of course, is yes. You can trade the CFD of S&P where it can go down to 0.01 unit. So 0.92 units become possible, but futures is not possible. It has to be minimum one contract, right? So there you go. Now you know what you are allowed to trade and what you are not allowed to trade based on the volatility, based on the risk. Another example, okay? I'm sure all of you can guess, yeah, what this stock is about, right? This is a very famous stock, yeah. Well, I think I don't need to give let you tell me the answer. I think all of you know, right? This is public bank, okay? This is public bank. So if you want to trade public bank tomorrow, let's say imagine today's closing price $20.38. Imagine that was some time ago, 217, right? So what should be the stop loss tomorrow if today's closing price do 0.38? And how many units of lots of public bank stocks are you allowed to trade? So the answer is very simple. ATR is 0.119, right? You just pop this in, this number will come out on its own. The turtles actually use 2N as a stop loss. So 2N is 0.119 times 2 is 0.238, means 24 cents, right? Turtles normally use 2N as their stop loss point. So 2N or stop loss is 20.38, tomorrow's opening price, assume it's the same as today's closing price, minus 0.24 is $20.14. That should be your stop loss. $20.14 is where you tell your remisier, I want the stop loss to be there. And how many units of public can you buy? Let's say one lot is you need to risk 238 ringgit. So total you are allowed to buy 21 lot of public bank. So simple, yeah. How many units can you buy? Where should it be your stop loss? ATR answered these two questions. And so the turtles follow this very, very systematic method to manage their risk. Every time they enter a trade, how to enter the trade? Simple, right? Break 20 days high. It can be gold futures, it can be silver futures, it can be palladium, it can be Euro USD, right? It can be S&P, E-mini, it can be bond futures, it can be interest rate futures, it can be anything as long as it's futures. It can be coffee, it can be soya bean, right? So to them, it's all the same, it's just numbers. And then when they enter, immediately they have a stop loss, which is ATR times 2N. Immediately they know how many units can they trade based on the volatility and based on the price of the commodity or the asset class they trade. So trading becomes so simple, right? So that's why they are able to train the traders in 2 weeks. It's pure mechanical, technical trading, no fundamental, no FA, nothing. It's just follow these few simple rules. And I tried this out for 9 rounds and I realized a few things, okay? Yes, if you have good rules, the rules works, okay? But that does not mean the traders can make money, all right? So there are some other things which enable the traders, whether they are successful or failure, there are other things. So let's take a look later. Now let's say whether is it real or not? Okay, so what I did is that I programmed the strategy in TradeStation and I test it out and see whether during the turtles time, did they actually make money with the exact rules described inside Way of the Turtle, or Curtis Faith was just messing with me. You know, the rules are not what he wrote. So I just try to replicate the system. So the result is 1 million, it can make about 1.3 million, and it has about 78% success rate in one of the product they trade, which is S&P. I don't have time to test all products. So to me, yes, yeah, the system works, the rules works. Whatever is described in the book, Way of the Turtle, just by using those rules alone, it makes money for system 1 and system 2. So system 2 was there, 1.3 million. System 1 is also about 1.3 million. It's about the same. So the success rate is also about the same. And then you look at the performance during the turtles' time, 1983 to 1999, you can see that not every year they make money, right? Yeah. Some years they lose money, but the years that lose money is very little. The years that they make money are more, right? When they win about 44%, 27%. They lose about 2%, 3%. Hey, seems fair, right? Seems fair. Seems that the system works during that time. How about our time? 2000 onwards, after the turtle program ended. So with 1 million, you make about 1.2 million. Well, still seems to work, right? About 74% winning rate. Okay, seems to work. But let's look at the volatility, yeah, using exactly the same turtle rules. So some of the years they lose a lot of money. Like 2000, they will be losing 59%, right? Or 29% in a year. And then some of the years they make a lot of money, like 148%. So what does that tell you? That tells you that you cannot just simply, bulat, just exact turtles rule, just apply to today's market and hope that you can win a lot of money. There are still some academies out there in Malaysia that teaches the traditional turtle system. And to me, that is quite risky because as you can see, the volatility is quite different from 1984. It has increased a lot, right? So you have to be careful. If you don't adapt to today's volatility, then wow, you are in for a big roller coaster ride by just applying turtle system alone. Okay, so that is my take on turtle system. Well, it might still work today. Okay, and just like any other trend following system, it is a typical equity curve. Whenever there's no trend, it will just be making some small losses. It's just waiting for one trend to come. So when the trend comes, you will make back all the losses and you make the gain. The winning rate of the system is only about 30%. 30%. You must be able to ride the trend. If you cannot ride the trend, there is no way for you to win. That is the turtle system. Okay? So it's a trend following system. That's how ATR was invented by Richard Dennis. That's how they used it that time. And today, are we able to still use ATR? The answer is yes, of course. So with the local charts of our local TC Pro platform of every broker in Malaysia, you have the turtle system, definitely. You can see ATR is there, yeah, ATR. Are you able to see? Yeah, ATR is there, average true range. And then you have Bollinger Band with ATR, and you can also have MT4 ATR. If you need it, I give it to you, ATR indicator in MT4. You can use it. You can download MT4. It's free as well, and you can test it out. You can what you can do in MT4 is you can fully automate the system, right? In MT4, the ATR, this ATR system MT4. Okay, I can give you the system. Definitely, it's free for you. So what's the summary? Trend following works. Okay, still works. Always works. In the short run, the capital drawdown can be huge. You have to be able to stomach, okay, a trend following system. 3 parts of the trend following system is difficult to stomach. First, there are many false breakouts. The winning rate is about 30%. Second, the break trend is very hard for Malaysian traders to ride it. Once you see a bit of profit, you cut your profit short and you let your losses run. That is normally the case. Yeah? So it's not easy to ride a trend. Third, the system will bleed capital when there's no trend. So most investors will give up after many failed attempts. ATR is still applicable today for risk management. Okay, let's see how it works for risk management. Okay, these are all the customized indicator. Yeah, for ATR inside MT4. Then you can also put in FKY, FCPO data and run in MT4 as well. Okay, now let's see how you can use here. So this is FCPO. Daily open, high, low, close. 4 data is needed for the last 20 days in trading view. So let's say you get this and then you just click into trading view. Of course, you have a free account and then you can see the ATR is here. 297 is the ATR, the minimum stop loss. So for the day is 297 times 2 is 594. This is recent example for FCPO, yeah, because a lot of people have been asking me, oh, Alex, do you know how to trade FCPO? It's crazy now. I said, oh, I'll give it a try. Yeah, so holding FCPO contract, trading needs how much? About 600 point stop loss room, which is about 14,850. That's what ATR is telling you. You need to risk about 14,800 per contract to trade FCPO now. It's crazy. Now I think the volatility reduced. That time was the craziest time when I did this example, right? So to fulfill the 2% per trade risk criteria, the account needs to be minimum of, right, 2%, right, of this, right? So it's 742,000. You need to have about 700 over 1,000 capital to trade one contract of FCPO if you were to follow the ATR rules precisely, and if you are a swing or position trader, not day trader. Day trader you need less, but this is for swing trader, right? So H4 chart is suitable for holding swing trade position for 1 to 2 weeks, right? So stop loss needed. This is a position trader, yeah. This is for swing trader 177. You can see the ATR is less. For H4, this is D1 chart. This is H4 chart. Times 2 is 354 points. So you need about 8,000 something to stomach one contract of risk, and account size need to be about 400 over 1,000 if you want to hold FCPO for 1 week, according to ATR. Right? Simple as that. All right. And then if you are a day trader, yeah, means you use H1. Your stop loss is 78 times 2, 156 point. That comes to about 4,000. So account size need to be about 200,000 to be a day trader in FCPO. Okay, so that's exactly what I try out. I just have an FCPO account and then try out, see whether it works well. Amazing. the trend are pretty consistent. So give it a try. I don't know, promote FCPO. Give it a try. Right. So applying ATR to set stop loss level, right? So that is exactly what I say. Right, so entry level, let's say is 6,000. If let's say the amount now is still about 6,000 something, the price, yeah. So the stop loss has to be 5850, and the exit point is 6150. So there's 78 points times 2, right? So I'm talking about day trading. Yeah, 78, right? 78 times 2, 156. So round out to about 150. So the risk is about 3,700 per contract. This is day trading. That's what I tried out. Yeah. So weekly risk management using ATR for daily calculation is about 297 points times 2 is 594. So this is holding longer. This is holding longer, yeah. So you need to be much more if you are doing a swing trade, okay, or position trade, okay, rather than a day trade. Your stop loss and take profit need to be higher. So I think you get the idea. Yeah, I think you get the idea. That is the ATR idea. Okay. And then, right, applying ATR in position sizing, right? So what does that mean? Stop loss is an alternative take profit method using 2 position. Yeah. So position sizing means how many contract, how to enter the contract. That's position sizing. So I want to introduce one thing is called RTZR concept. That's called race to zero risk concept. Means that you want to be zero risk as fast as possible. That's a very interesting concept to trade anything, futures or stocks. The very purpose of trading is to be risk-free as soon as you can. The very purpose of trading is not to make money. It's to be risk-free and has the chance to make money while have no opportunity to lose money. That is the purpose of trading. Position sizing. Okay, so that is called RTZR concept. So every time you have the first take profit, always move the second position to break-even point. Okay, always move to break-even point. And with that, you'll be able to control your risk better. And with that ATR apply, that is roughly your winning rate. Okay, that is exactly what I tried out. Okay, from December until February, you do day trading, a bit of scalping, right? Breakout strategy. Okay, with 50 trade sample collected, I expect about 60% win rate. 30 over 50 in reality, I get about 33 over 50, about 66%. Okay, so a bit of mistake here and there. Okay, so yep, ATR helps you to manage your risk better. And of course, for position sizing, there are a few ways. One is you just enter one contract, get your stop loss out. Second way is you have 2 contracts. When the first take profit, second move to break even. First take profit is you take profit faster. Let's say 200 point stop loss, first take profit is 100. And then you move to break even, and then second take profit is second one is already risk free. So that's very important. Okay, and of course you can improve it, like extend it to multiple contract, right? Become very complicated. You can actually do that. You can definitely do that. So I'm not going to explain too many. There are many ways to do position sizing, but I'm just going to give you the most simple way is either you enter one contract with just stop loss and take profit, or you enter two contracts with one stop loss, same stop loss and two take profit point. The first take profit point is half the stop loss. Second take profit point is the same as stop loss. And when you hit the first take profit, move your stop loss to break even. The trade is risk-free, raise to zero risk. That is the basic concept I want to introduce to you tonight. Okay, and there are many, many ways to manage risk using ATR. Okay, so that is recap. That is the risk reward, okay, of using different ways. And this one is you just average down 4 level, and then when you go back up, you can increase your risk reward to 1 to 2.2, provided both are still 200 points stop loss and take profit, but your risk reward is much higher by having 4-layer entry instead of 1 layer. Okay, like entry at 6,000, 5,950, 5,900, 5,850. That was what I did, and then it reversed back up. And even though the stop loss is 200 point, but because you're using 4 layer instead of 1 layer, your risk reward increased from 1 to 1 to become 1 to 2.2. That is the type of risk management I use, the use of ATR. Okay, so what is the edge expectation? Yeah, all the possibilities that you have, all wins, all lose, some win, some lose. Total, you have a positive edge expectation. So that tells you that when it comes to risk management wise, you have done the right thing. Okay. Next question, of course, is how to automate this whole thing. Of course, you can automate in many brokers right now, like RHB, like some other platforms like CIB, you can automate. The thing is, you need to pass their user acceptance testing process, the UAT certification. Okay, so that's an example, right? You want to automate stocks, you need to get the approval of the API vendor of the broker. Let's say it's end-to-end, right? And then if you want to automate futures, let's say in RHB, you need to get QST, quick screen trading, to approve you the UAT, then you can automate, okay? And then I'm going to show you an example of how you can automate futures trading, FCPO, FKOI in RHB as an example. Of course, you can do it in other brokers. So what you can do is, first of all, you open up this software called Spider. Okay, Spider is why I use Spider is because we are using machine learning to predict FCPO. That's why Spider. So after we launch Spider, okay, we will open up a script that is provided by RHB so that we can connect our platform to their backend. Okay, that is provided by them, and then we also install WinRHB. Okay, wait for the lab to launch, and then you have all the password. Select the right server in Hong Kong, ours, and then you log in. Then you will be able to see your account. Okay. Then after that, you use check whether what are the products available for automation, and then you can just go to Web APS JavaScript. That is also provided by RHB, and then you open this up, and all you need to do is just to make sure all the entries and server are all correct, and then you click connect. Once you click initialize connection, your computer, which has the algorithm to trade FCPO, FKOI, is now connected to RHB's backend through their QST, quick screen trading API vendor. Now you are connected. So once you're connected, you can automate. You click run, you can automate your machine learning algorithm to predict FCPO and fire this order to RHB to execute the trade. Everything is fully automated. This can be done with QST. So if you want more information, always ask your broker's IT department whether do they allow you to automate your FCPO and FKOI trading. So we did it at RHB, so I can show you how it is done in RHB. Okay, that is the automation part with the local broker. All right, so last but not least, I want to show you the engine behind our FCPO automation. Of course, we are not using human to go and guess whether FCPO is up or down. We are using algorithm. We're using MRN technology, machine readable news technology. And with the news, okay, we have a way to see all the news, and then with that, we predict whether, you know, is it a good or bad sentiment from the news. So predict FCPO price up or down. We do that for index futures. We do that for stocks as well. All right, and then we train our FCPO model using LSTM model, which is the long short-term memory model. Okay, LSTM model. We train them, and then so that they will be able to predict FCPO better. And I give you one example: is let's say you feed it, it auto extract FCPO price. Let's say the last price 2424, and with our machine learning model, it predict that in the next 1 week, it will go to 2444. Means it's predicting in next week is going to go up about 20 points. Yeah, 20 points. So what happened was that 2 days later, it went to 2444. So that is called machine learning prediction, and everything is fully automated and is fully executed, automatically executed through QST in RHP. So that is our machine learning platform, machine using LSTM. Okay, there you go. That's LSTM, right? Predicting whether today is what's the chances of going up, going down, or going sideways for FCPO, for FKLI, as well as for NASDAQ, this and that. Yeah, we have we use it on a few products. Okay, so machine learning fully automated, executed in RHP for FCPO and FKLI. Okay, so I think I have actually give you an idea, right? The idea is, first of all, you must have a way to manage risk. Okay. Secondly is, nowadays we automate risk management. Like you can see that you can do it in MT4, right? When to cut loss, everything, and then you fire from MT4 to your local broker. That risk management, like where is the stop loss, where is the take profit, and whatever trade model you train in MT4, like all this machine learning, you can also fire the order over to your broker. And what is needed is the bridge from MT4 to the local broker, MT4 to RCIB, MT4 to Maybank, MT4 to RHB, MT4 to Affin's backend, their API vendor, MT4 to JF Apex, their backend vendor, which is trading technology. That is the key part, and the bridge is the difficult one that a lot of people did not know. Yeah, the bridge is actually 0MQ. 0MQ is the bridge. Anyone who know how to bridge this, you can make a lot of money. Yeah, there are very few vendors who help people to bridge from one platform to another platform. That you have something in, let's say, in multi-chart, it can be done in MT4, something from MT4, it can be executed in TradeStation. That's called bridging technology. And anyone who does that, now is the hot part. Now is the demand. Is in hot demand. So hits that programmers would to go into this business makes a lot of money. So that is actually using 0MQ to bridge over from MT4 to all your algorithm or Python or whatever into the broker for execution, automation execution. Okay, so I think I have given you a brief idea. Of course, 1 hour I can teach you what is LSTM, how LSTM works. That would be the whole day's topic. It takes us a few years to really get it right. How to basically use LSTM, like, oh, this week is going to come down, next week is going to go up. It's the predicted week-to-week value. It has all the possibilities, and it gives one potential path to let the trader know. Computer doesn't need this chart. This chart is for traders to know what the AI is going to do, where the machine learning is going to do. Okay, all right. So I think that is actually what how you can actually trade FCPO now and FKLI now, also any other products which are available in a local platform. Today is really not about manual trading, but it is still about risk management. There will still always be a need to risk. Doesn't mean that, oh, I have machine learning, I don't need risk management anymore. I don't need to manage risk anymore. My machine can take care. No such thing. You still need risk management. And therefore, ATR can still be applied today, but you can automate ATR in MT4 in some other platform and bridge it over to your local platform. Okay, all right. So, and then of course, automation of news, absorption and news, all these news technology are available for local news, like to trade Malaysian stocks. There are companies that provide MRN for local news. Reuters and Bloomberg, they also provide MRN for local index like FKLI, all this. You can ask them. You can ask them. They have that type of technology for local news and local data as well. Okay, all right. So I think today I'll just briefly share. Okay, if there's any question at all, okay, you can just type in at the chat box there.